I want to welcome you to the the Major Nonprofit Accounting Changes Seminar. I've given this seminar a couple of times, and I was asked by Jack to give it again today. Our agenda is going to be basically an intro, kind of a little welcome, and then I'm going to give you an overview. The overview is really, really condensed. Literally one slide, so don't panic when I get there. I'm just introducing you to what I'm going to cover, and then we're going to go actually into the details of the accounting rules. I'm going to preface it by saying there's a lot of information here. So if you leave here going, I got pieces, but I don't get the whole thing, join the club. A lot of accountants are also trying to digest all the new rules, like any new set of rules. So let's general introduction. I'd like to just give you a general. A number of you know me. A number of you are clients of my firm. Deal with either myself or my partner William Scot. Those that are not clients or associated are consultants, and the rest of you are just great people. I'm a co-managing partner of a boutique CPA firm in Manhattan called Scot & Company. We've been in business now 27 years. And we're a boutique firm because we specialize basically only servicing not-for-profits. We're very unique because we're only one of a couple of firms, literally a couple of firms in New York, with all the CPA firms out there that have as many not-for-profit clients as we do, which is fortunate. We now handle over 100 audits, probably more 990s or 990 EZs than any other company. We're probably doing over 450. We cover every kind of not-for-profit, from those working out of the executive director's house or board member's house to having a bank foundation. So we have organizations that have gross revenue of $15,000 going up to gross revenue of $300 million. And every type of C, or no, I take that back, not every type, but a large number of C organizations, mostly C3s, a number of C6s, C4s, which are the IRS designation. Our specialty is audits. My specialty, what I do, in addition to running the firm, is I give a lot of lectures on important management related. So what we do a little unique is we don't just do the audits, which, by the way, you guys know, dealing with auditors, it's adversarial at worst and not so bad at best. But what we try to do, my partner and I, is in addition to doing our audit work, help our organizations, help the executive director, help the board of directors comply with all the rules, the myriad of rules that not-for-profits have to follow, which are in addition to reporting to the government, or reporting to grantors, to reporting to vendors, bankers, board members have to understand what's going on. So there's a wide range of reporting responsibilities and obligations of not-for-profits. So that's basically what I do for a pay, not necessarily lecturing. But with that said, I've been teaching for over 20 years, undergraduate, graduate, just so you get an idea. And I've been giving lectures and seminars to not-for-profits for the last 15 plus years. Some of you have come to my class. I created a unique certificate program in not-for-profit accounting that was given first at NYU. It used to be called School of Continuing Professional Studies. Now it's School of Professional Studies. Then they kind of knocked out all of those certificate programs. I then moved it over to Baruch, Mark's school, and then there were some changes here last year, and I've been fortunate to get another school. Fordham University has decided to offer my certificate program beginning in the fall. They also have agreed to offer a brand new certificate program that I've been trying to get off the ground for about 7 years, which is a certificate in not-for-profit bookkeeping. Bookkeeping. It does not exist. For those of you guys who work in some kind of management position, you know how hard it is to get not-for-profit so-called bookkeepers that specialize. So I created this course. I'm in the process of writing it, and it'll be the first one offered in the country. I'm you guys are the first audience to hear about that. To give you one last final piece about myself, in addition to servicing my clients, I know what a lot of you face. I've been on boards, I've been a treasurer, I've been a chairperson, I've been a regular board member, and for that I know what the inside is. So I know what it's like to deal with the auditor. I know what it's like to deal with reporting rules. I also know what it's like to deal with other board members that are being, let's see, I'm being filmed, that are not always the easiest to get along and sometimes obstruct getting things done, yet they're on the board. So I know inside and out, and that gives me kind of a unique take. But that's not why you were here. But you're here to hear about the new not-for-profit accounting changes. So I want to get a general feeling, I'm pretty sure it's 90%. How many of you work for not-for-profit? I should have did it the other way. Okay, I was thinking anybody don't work for not-for-profit? Okay. Yeah, you got my curiosity. What do you do?
It's both. It's a company and a foundation.
It's a what?
A company and a foundation.
Company, and so you have a foundation. So, okay. So you're still in that realm. Okay. So let's go on the overview. And again, I'm going to give you very general, so don't freak out. All right? But a little history. Just it's only one slide, so it's not going to be that boring. Little history. What are the accounting rules? You know, people say this all the time, and they use the term very freely, don't understand it. So again, those who have taken my seminars, I know I always cover this. I'm going to cover it here. Who's the rulemaking body? The rulemaking body is the Financial Accounting Standards Board, otherwise known as FASB. They are the sole rulemaking body since 1973. So they've been around a while. And their mission is to establish accounting rules for all reporting in the United States. This is what most of us hear when accountants throw out the term, we have to be in compliance with GAAP. GAAP is generally accepted accounting principles, which come from the Financial Accounting Standards Board's pronouncements. Now, for us, in the not-for-profit world, we're mostly concerned with the not-for-profit accounting rule, which didn't exist, by the way, before 1993. There was kind of a hodgepodge, but no official rules. In '93, the FASB came out with two pronouncements. SFAS, Statement of Financial Accounting Standards 117 and 160. Now why am I saying that? Because you're going to hear a derivation of that in the future. 117 has to do with financial statements. And by the way, that's what was revised. 116 has to do with something we all deal with, don't always understand, and that's contributions. Contributions received, contributions made. There is a pronouncement on its way out very soon that's going to affect what used to be Financial Accounting Standards 116. So that is on its way. It's in production. They're going to be releasing it. If we have time, and I hope we will, I'm going to touch on it very quickly at the end of this. And if I don't, I'll be happy to explain it to you after the class. So these two FASBs are no longer mentioned 116, 117, because in 2009, was it, I believe? 2009, the Financial Accounting Standards Board basically codified, took all of their pronouncements, and the number was up to I don't remember exactly, 130s. They took all of them and they put it into a tome, one huge kind of book. Of course, it's electronic, but one book that has all the accounting rules. And instead of saying 116, 105, 95, they now call it Accounting Standards Codification, ASC. And now if you read financial statements, you're going to see reference in the notes to ASC. What we're mostly concerned about is 958, which deals with financial statements of not-for-profits. 958-205 is the presentation of financial statements. 958 has some other categories, other areas of not-for-profit reporting. This is the one we're going to be talking about today. Now, the reason you guys have a handout is you're not going to be able to see some of the things on the slides. Excuse me. Between 2014 and 2016, there's been a number of FASBs passed that affect not-for-profits.
You have any more hands?
If there's not, what I'm going to do is I'm going to get everybody's email from them and I will send it. I'm sorry. If you want, you could sit up front here and see. You could share? You're a good guy. Okay, so 2014 and 16, major FASBs that were put out. What they now call it is Accounting Standards Update, ASUs. And the ones that I'm going to talk about, there are 4 up here. And some of them I'm not going to get into because one of them alone I've given seminars for several hours on, so obviously we can't get in. But you will leave here with at least some understanding of what these are. The first one and the main one I'm going to cover today is the presentation of financial statements and not-for-profits. That's ASU 216-14. Operating leases are going to be coming out in a couple of years. That's going to affect all of us too. And that is 216-02. Then there's something that affects every not-for-profit and every commercial business. The only thing is, fortunately, it doesn't affect not-for-profits as much, and that's the revenue from contracts with contractors or customers. Basically, every contracted to sell something or services or product that has an agreement will be now falling under this new accounting rule, whether you pick it up or don't. Pick up meaning will you book it or make a recording of the transaction. The last one on here that I'm going to cover is going concern, 214-15. Fortunately for most of us, if not almost all of us, going concern is not an issue. Let me put it this way. If you have a going concern, you should be concerned. It's a very serious thing. It basically means your organization is teetering on going out of business. There's new rules on that. And the last, all the way down there, is an exposure draft FASB has out on how to treat contributions, which is sorely needed. Because I can tell you for a fact, you put 2 accountants in the room, you give them a set of facts about how to treat a government grant, and the 2 accountants are going to have 3 suggestions how to treat it. Well, anybody that's dealt with government contracts, or even donations from a board member, is it restricted? Is it not restricted? Does it have a condition? Is it a condition and a restriction? So the FASB came out and it's supposed to be clarifying it. It's supposed to be. I've read a preliminary on it, and I think it does to a lot of extent. But again, we'll see what it does in practice. So those are the 4 we're going to touch on. Unfortunately, some of you do not. No, I take that back. Not some of you. I don't think anybody has the sample financial statements that I gave them to print out. I guess there was a lot going on here, to be fair, and they're trying to juggle it, and they didn't print it out. And I'm sorry about that. Again, I will send you all my handouts. I'm going to get a printout of everybody's email from them. And so it's going to be a little hard to see up here. I usually ask people to follow.
Larry, there is a financial statement.
Yeah, I know, but that's on the slides. I actually gave a full financial sample that I put together. So I will send it to you to give you some guidance. And again, changes are highlighted, but you're not going to see that, so you'll see it highlighted on the screen. Okay, let's go to the summary. These are the major changes. And this has to do with the 216-14 financial statement, which is the crux of today's kind of seminar, workshop. The major changes. Here is what I try to prioritize what I think is the most important. So I think the first one is what was considered the major change. Now a little backdrop here. In '93, when the FASB came out, 117, and they switched from everybody doing different ways of reporting not-for-profit activity to this, the organizations that had to do the new rules really freaked out. What do you mean by temporarily restricted? What do you mean by permanently restricted? Unrestricted, I think I understand. It took years and years for organizations to get a little comfortable. From '93 to, 25 years, I can tell you, many organizations and many of you kind of understand this, and still there's a lot of confusion. Now, when we finally got an idea and a handle of what these mean, they changed it. Why did they change it? Well, this is, I'm reporting to you as a messenger what FASB has said to me. And not just what FASB, what people said to FASB to make the change. We're changing it to make it easier. Easier for the reader to understand what's going on. Now, I think that statement bears repeating. We're doing this to make it easier. My personal feeling is I don't think it necessarily made it easier. It makes it easier for large not-for-profits, those that are in the tens of millions and up, that have the resources to configure their financial statement, but more than that, have their books set up that will generate the reports for the financial statements to capture what they want. For most of the other not-for-profits, the smaller ones, and I don't mean small, when I say smaller, it could be under $10 million, they don't have the resources to necessarily comply with all this. Nevertheless, everybody is going to have to comply with these new rules. And they're going to be, I think, a little painful in the beginning. So, again, we're breaking down the net asset categories were 3 as of now. Unrestricted, temporary, and permanent is being changed to 2 categories. That's the thought of it making it easier to with donor restriction and without donor restriction. And I'm going to delve into that, what it means. So again, 3 to 2 has to be easier, right? We'll see. Another change is you have to separately report cash that's restricted. So if you have an endowment that money's in cash, or investments for that matter, or the board restricts money, or a donor says, I'm giving you money that's temporarily restricted for several years, you must separate that cash now in 2 lines. You can't lump it in with cash. Another change, and this is the one that I'm going to really hone in on the later slides, is that you now have to provide quantitative and qualitative information about your financial assets and your liquidity. This one area, when it came out and I was reading it, I said it's going to cause the most problems. First of all, for people to understand what they mean by qualitative and quantitative, and 2, when you report it and the organization starts seeing how much financial assets are not really available, I think it's going to cause a lot of problems with the organization and their presentation. And basically what it means is, let's talk about quantitative. It's saying how much money, excuse me, how many of your financial assets, which is defined, it's a couple of areas, cash, investments, accounts receivable, how much is available for general expenditures? Now, hone into one of those 2 words, general expenditures. There's where the problem, I think, comes in. We're going to talk about that. The other thing is qualitative. How does the organization manage its liquid assets? Meaning, how quickly do you get your funding in? Do you have any bank loans or any credit? You have to report that too. And the reason I say this is a big problem is because a lot of not-for-profits, as you guys know intimately, is cash poor. So it's bad enough that you know you don't have money, and you know that people reading the financial statements are going to kind of see this. Now with the new financial reporting, it's going to be right there in bold, explaining what you have or what you don't have. And the problem is what you don't have. When you have it, you don't have a problem, like everything. So that's a big area. Another one which is not a big deal is the statement. It used to be under the old rules, statement of functional expenses, that it's now required of every organization. It was only required by some in the past. They call it voluntary health and welfare organizations. Now, that's not a big deal. In my firm, we prepare this statement for every organization. It should have been, and they just kind of changed the rules to do what I think is, should be. Reporting underwater endowments. We'll talk about what we mean by underwater endowments. One, if you're fortunate enough to have an endowment, that's good. If it goes down in value, it's not good, and it used to cause a very big problem for this is mostly for larger not-for-profits, but some smaller ones do have an endowment, so it could be an issue. Investment expenses, not a big issue, how you report that. And actually, I think that was a helpful change. It cut down some of the reporting. And this one won't affect most of you. It has to do with how do you record a donated building. How many people you know got donated buildings? And the crowd goes wild. One? Okay, all right. That's, well, this is a change going forward.
What if a building is named, though?
Excuse me?
What if the building is named, or you give a large fund, and then they name the building after?
Oh, I don't think it makes a difference if you name it, you know, Laurence Scot's building. It doesn't make a difference. I think it's the donation that's the issue. Okay, so let's delve in. Unfortunately, this is one of those things you don't have a handout, but sorry guys, because the handout I gave you was the financial statement. So I will read it for you. And again, I apologize. But all you have to really see here is basically I want to bring your attention to some of the highlighting that we're going to go in. This is just for illustration. We're going to go into each statement, which is a blow up. But I highlighted some of the major areas that the financial statements are going to be much more expanded on. This is just for illustration. And I want to mention one point. There's a lot of variation, acceptable variation for presenting financial statements, as long as you get the information out there. So you'll have several different accountants or auditors will suggest this method, will suggest another method where you put with donor restrictions on the bottom, others put it in the middle. So there are acceptable, I just want to get that across to you, there are acceptable variations. So what I'm giving you is the presentation method we use in our firm. It doesn't mean that others are wrong. The last statement, which we're going to go into more detail on, is this statement, which used to be called the Statement of Functional Expenses, but it's actually going to have a different name a little bit, because it's not just functional, it's functional and by natural class. So this will be the new statement, and the thing is, every organization has to do this statement. I think it's interesting because in the FASB update, the 21614, they said that this information will probably be presented in the notes. Now, if any of you guys, and a number of you I'm sure, have read financial statements and know the notes are in the back, which is textual mostly, could you imagine putting a schedule like that? You know, it's almost taking an Excel and sticking it. That's what they said. I don't see that as happening. This is going to be a statement, not a disclosure in the notes. But that's what they said. You need to have this disclosed in the notes. Okay, let me drill down now. And this is a little easier for you to see. So, what you're supposed to do with your assets on the financial statement to be in conformity with the rules, you're supposed to list assets in the order of liquidity. That means how fast it gets converted to cash. Cash should be the first, but then you move down to receivables and investments and move down. You're also supposed to list your payables and your other liabilities in the order of payout, meaning how fast you have to pay it out. Great example is a bank loan. If it's a short-term bank loan or note, you have to pay it the next year. If it's a long-term loan, it would be paid out long-term. It would go further down. So you list your assets and liabilities in that order. The main change, other than, as you can see, breaking out the cash that's restricted, where it might have been included up here, is broken out on its own line further down, because cash and cash equivalent is restricted for endowment, meaning you can't touch it. It's pretty much on the bottom of your assets. In addition to that big change is the change to the net assets. Again, we used to have 3 categories: unrestricted, temporarily restricted, and permanently restricted. Again, putting aside that not everybody understood those 3 categories, they collapsed it into 2. It's now net assets with donor restriction and net assets without donor restriction. And here's the justification about this change. It's a lot easier having 2 categories, because when you had with donor restriction, that was falling under temporarily restricted, and then you had with donor restriction that was permanently and had an endowment, and you had earnings and you could use it, but you couldn't use all of it. It got confusing where it went. So they felt that putting it into 2 categories was cleaner. Here's why I have a difference of opinion on that. It says you could collapse it on 2 on this statement, which means 1 number. But then it goes on to say that somewhere in financial statements, such as the notes, you need to break it out further into not just the old categories, but more detail. So not just did you need unrestricted, which you would just have unrestricted, you now have to have without donor restriction broken up by undesignated, and board restricted, which is not external. In other words, the board says we have extra money, we are going to restrict some money for the future. A rainy day fund. Now, if the board separates that money into further categories, board restriction for programs, board restriction as a reserve, you have to further break that out, I believe, if it's major categories. Some people might not. Somewhere. So if you do it in your notes, it's still a matter of work, extra work. Now, with donor restrictions, used to just have temporary 1 number and permanent. Now you actually have to break out what type of restriction the donor is. Purpose, giving you money for a specific thing you haven't done yet. Or a time restriction, here's money to be used in 2 years. Or the endowment, or some derivation. So you now have what used to be 2 categories, actually a lot more. Again, they said you could do it in the notes. I think burying it in the notes is not a good way. I think it should go right on the face of this statement. Which gets us all the way around to, we made it less, but did we really make it less? But we are giving more detail. And most of you and most organizations, their accounting system is not set up to do this. If you're like most organizations, you're using QuickBooks. How many people here use QuickBooks? Yeah, it's usually anywhere from 50 to 75%. QuickBooks or QuickBooks desktop or online, either or. QuickBooks does not really allow you to separate your net assets. I mean, there's ways around it. Only the real more expensive programs, like Financial Edge, will allow that. So there's no real ability, so there's going to be a lot of work at year end. That is a major change. In addition, so that was on the statement of statement of financial position. On the statement of activities, now you have to, instead of saying again, your income, what's my unrestricted income? What's my temporarily restricted contribution? Somebody giving me money. What's my permanently restricted contribution? You now have to follow same rules, with donor restriction, without. But again, you've got to further break that out to the type of restriction. So the method of presentation, as you can see up here, I'll restate it for those in the front that can see. You will have a column that it says with donor restriction, and a column that says without donor restriction. And I present 2 years, like this year and last year. And I want to bring your attention, although I'll read it, to where it says a net assets released from restriction. We used to have 1 number. So basically, if a donor said last year, here's money to be used for next year's program, and this is the next year, and you're releasing it, you would take all the amounts, total it, release it from temporary restricted, put it into unrestricted. It's just a reclassification. Now you've got to further break down the restriction, release from time restriction, release from program, and release from type of program. If you have major programs, like a lot of bigger organizations, you're going to have to say what your major release is for, so that the reader gets it. Not less information. more information. This is not a big change. I should have probably started with this so everybody doesn't panic. But in the past, only voluntary health and welfare organizations were required to present what used to be called a statement of functional expenses. A statement of functional expenses is a two-dimensional schedule. It shows your expenses, as most of us understand expenses, by natural classification, such as salary, rent, office expense. That we understand. And by function. Function is by major program. You could have one program or several programs. And by supporting services, such as management in general and fundraising. So the schedule of statement used to be called a statement or schedule of functional expenses, and only required, as I said, a voluntary health and welfare organization. Now this is required for every organization. That's the only change. But is the title really accurate? Statement of functional expenses. It's not just doing a statement of what your total functional. It's really doing both. And so the name should better reflect it. They didn't really say what the name is in the FASB. That's where accountants are going to have to be a little creative. I'm suggesting they call what it is. Statement expenses by function and natural classification. If you don't like that title, because it's too long, you could call it statement of expenses. It's still accurate, but it's two-dimensional. And here's another add-on. You must explain, which a lot of organizations were doing, how do you allocate your expenses? Now, I actually think this is a very good disclosure for a reader, and I know it's a very bad disclosure for the organizations, because again, most organizations don't have an organized way of allocating expenses. And most of the expenses that get allocated tend to be salary, personnel costs. Great example, or the biggest example, is you have a small organization, the executive director is wearing many hats. The executive director is running around to raise money. The executive director is managing the organization as the executive director. And because it's a small organization, the executive director is doing whatever the mission is, the program of the organization. So you should be allocating a portion of the executive director's salary and related expenses among the major functions. Most organizations don't really have a system for them. Some of them a little bit more financially savvy or have the ability to allocate this. Many times the auditor does it. Well, in the past, it was done pretty, loosey-goosey, where although we try to make it as reasonable and rational, how much time does the executive director spend doing the program, doing management, and we'll do an allocation. Under the new rules, you must disclose how you allocate. So I gave, and again, if you could read on your slide, I gave a suggestion of a sample note that says basically we allocate somewhere down there, expenses that require allocation on a reasonable basis and it's consistently applied. The expenses that are allocated include salary and related expenses. It does not say to what detail. And I'm a big proponent of you put down and you disclose what you're required to do, but not more. Now this is something that I have a very strong feeling about. Many times my firm takes over doing the audit or doing the financial statements for another organization that had another auditor. And many times a lot of other CPA firms that are not experienced in this area, they don't know the rules and they don't know how to disclose information. And they're feeling, and I've talked to these partners, we weren't sure so we just put it all out there. There's a problem with that theory and I want to interject that here. Putting down more information than you need and elaborating sometimes might cause a problem with it conflicting with something else you put down. So just throwing it all out there might cause you a problem where it becomes confusing. So I don't say to be obfuscate and not put things down. Put down what's required, do not elaborate, do not embellish. I know a lot of organizations want their mission to be a page, they want to use it as a promotion. If they change their mission or they change their program, this causes a problem. So I'm interjecting that. It's not the new rules, it's pretty much the old rules too. So with the new rules, it will be a problem, those that don't know how to do this. here's the big kahuna. When I read this, I said, I don't want to be on the receiving end, which I will be, on hearing organizations say, we have to do what? Now, on that first slide, I said when this is effective. I didn't mention it, but it was up there. This new accounting rule, these accounting rules, are effective for years beginning after, I love the way accountants talk, beginning after December 15, 2017, which basically means 2018, which basically means statements probably won't be put together until 2019. So we're already in April, so it's becoming more and more important to understand this. But this, to me, is what's going to cause a problem with most organizations, or a lot of organizations, that have liquidity problems, or cash flow problems, which unfortunately many not-for-profits do. So I said you have to provide quantitative and qualitative information. Here is my biggest issue with that, and I'll explain those two categories, qualitative and quantitative. It's the term general expenditures. Basically, you have to report in your financial statements, in the notes, how much money and related assets you have are available for next year, within 12 months, general expenditures. Now, I would raise a question with all of you, and we could have a half-an-hour discussion. What do you mean by general expenditures? Because that's the issue I have. What do you mean general? For example, let's say I'm the donor, and I say, you started this after-school program, I want to go to another grade, I wanted you to do it earlier, and I'm willing to give you $50,000 to start that program next year. Is that general expenditures? You already are teaching, and you have this program. It's not a teaching, you're providing this program for students. You're doing another grade. Is that a new program? Is it an existing program? Is it general expenditures? It's what you normally do. So when I saw that, I had a big problem, because to me, so many things, so much money you get, so many things are not general expenditures. Do they mean general expenditures being just management in general, not program? No definition in the FASB, in the update. So I think that's a big problem. I've raised this question to 2 representatives of FASB while they were giving a seminar, and I will repeat to you what they told me. What you do is you define your general expenditures. Anybody see here a situation that's going to be a little confusing? You define it. Now, they did a lot of these rules to make it more consistent, so that you can't play around and be more subjective. But in this area, I think you're causing subjectivity, and it's a big, and people are going to look at this before they give money, before they loan money. How strong are you? And as a lot of you know, a lot of organizations, in fact, are using funds that are, and this is not right, but they use sometimes restricted funds to survive, or funds that are given to them that the board set aside, but didn't set aside, but are setting aside, but maybe won't set aside. I say that statement because that's what boards are going to go back and forth with the disclosure. So first, let's go break it down. Okay, so you have to do your quantitative disclosure. First, it says, what are your financial assets available for general expenditures? What are financial assets? Well, cash and cash equivalents, not cash that's tied up, receivables and investments. Those are your bulk of them. So how much in these areas do you have available for general expenditures? And you must report that in your notes. And you have a couple of ways you can do that. You can take all of your financial assets and then pull out what's restricted. You can list each one separately. You can have a total number. So there's a couple of ways of doing this, and you're going to find accountants doing it different ways. Now, a little aside. I'm on a committee with CPAs that specialize, not-for-profit accountants. And I can tell you when this came out, the general consensus was let's wait to see what the big firms do, so we make a determination what we want to do. Nobody wanted to jump the gun and start taking a stab out of presenting this. By this point, there is a lot of literature out there, and firms are diving in. It's that sensitive, and many people agree with me. Many people being the CPAs and some of the organizations, as this is going to be a very big issue. So again, financial assets. Then, you know, you have to how you disclose it. So in my example here, I have total financial assets. You can break it out where you go cash, investments, receivables, total, and then do it. Or you could do it total, both options. Then you break out what is restricted that's not available for general expenditures. Less restricted by donor with purpose restriction. Less restricted by donors with time restricted. Less amounts held in endowment. You pull that out, and you go, what's basically available for general expenditures. Now, one other piece that I think is going to be a moving target. If the board separates and sets aside some money, which is called board restricted, not external restriction, board restricted, you must list that here. And I'm going to make the statement right now. If that number comes down very low, meaning at the end, I only have $1,000 available, or worse, it's negative, and it will be negative. I can tell you a number of organizations I know full well will be negative. That board restriction is going to change automatically, which means technically the board has to have a meeting, the person who's reviewing can't say, oh, change it, pull the board restricted out. No, the board has to vote on it. I think that is going to be a very big issue. So that's the disclosure on the quantitative. On the qualitative, you must say how you manage what they say you manage your liquid assets and resources. And I gave a sample qualitative disclosure here, saying as part of our liquidity management procedure, we have a bank loan that we can use, and it's available. A donor who gave us an endowment has said we can contact them and they will release it. Whatever availability that you have to funds other than what we classified in the quantitative, you need to disclose here. So that's what they mean by the qualitative. Now, I said it and I'll repeat it because I think it's important. They're going to have problems where they have to disclose that you have very little money or negative. Anybody seeing this? Now, is this changing what was done in the past? Not really, because somebody looking at the financial statements will see your cash and see some of your restriction, but it wasn't easy to glean out of it. This one's going to be glaring. It's right there. I mean, you could look at the bottom number and see unrestricted net assets minus 40,000, temporary restricted assets positive 100,000. The net, it gives you 60 if I added it right. You see why I have negative unrestricted? So you could kind of know that, but here it's going to be right in the notes for the reader. And this is what's going to cause a lot of problems. The other thing is how you define your general expenditures. And again, I gave a sample note here, which I came up with, that basically says our policy is to include in general expenditures are all expenditures for existing programs, okay, or related to existing programs. And that you're allowed to do. And that gets rid of that. And you can even say, if it's restricted for the year after, but it's something that is so available or can be changed, you should be putting it in here. This disclosure will become very, very important. So I can't emphasize enough how important this one area. And this is where I think we're going to be getting the most calls from. I'll ask you right now, just short, I don't want to get in discussion, but anybody have a glaring or a major question right now on this? You're that lost, huh? Okay.
Can I ask?
Yes.
So you don't need to keep any quantitative number for the expenditures, right? Just the qualitative, like that these are our expenses within next month.
You don't, the expenditure disclosure is not required, which actually makes kind of sense, you think so, but no, only what your funds available. So what is your general expenditures? There's no number there.
Right.
You could assume that your general expenditures, well, you can't say what the general, but your expenditures next year will be at least similar to this year. That's about all you can get out of the statement.
Yeah.
But what is your general expenditure portion? Nowhere. So if you define it, as I said back here, if you define what your general expenditures are, existing programs, management in general, and fundraising, now, is fundraising a general expenditure? You could define it here, yes, or you could define it here, no. And that's the first question I've gotten on this. I expect about 10,000 more. Okay. Underwater endowments. Just to get an idea, how many people in the room, their organizations have permanently restricted endowments? 1, 2, 3. Okay. So most of you don't. This won't affect you. But I'm going to give you the summary definition of what they mean by underwater endowments. Let me give you the background. The background was a little harsh. Here's an example for the background. Somebody gives $1 million to the organization, to your organization, and says, you can use the earnings from it any way you want. It's unrestricted. Okay? Straightforward. Now, under the old rules, the old accounting rules, you were supposed to maintain that endowment at the cost, what it was given to you, the corpus, the principal. $1 million. Now, you're supposed to report investments at fair value. That is an accounting rule. So every year, when investments go up and down, when I say investments here, these are traded investments that are on stocks and bonds, not any investment in partnerships. Freely traded investments that have quoted prices on the exchange. You're supposed to maintain it at fair value. So, when the market's going up, that's great, that's not an issue. But as some of you might remember, 2008, the market went down. And times when the market goes down, under the old rules, your investment, which was $1 million, might be $800,000. And on the old rules, you were required to maintain the value of your endowment at the amount that was given to you, which means you have a loss of $200,000, which means you're supposed to make that up, which means where do you get the funds from? You're unrestricted. Now, if an organization is pretty close to the line on their income to their expenses, and they have an investment they're not touching, to go and reclassify unrestricted money to permanently restricted was pretty onerous. But that was the rules, the accounting rules. Now, the federal government, it was actually a group, but it federally came out with the what was called the Uniform Prudent Management Act, financial management, which said that how organizations and money managers should manage trusts and funds that are being held. And basically, almost every state in the country had some variation of this. That rule was different than the accounting rules. That rule said that basically, under the old rule, the management rule, it was similar to the accounting rule. When they passed a variation of that, they added the word prudent. So it was the Uniform Prudent Management Funds Act, which said how fund managers and organizations had to manage. And what that said is, you can actually take money even if your investments go down under the original value. That was the rule that was passed by almost every state in the country. I think 48, if I remember, plus DC and the U.S. Virgin Islands. One of the, I don't know if it's Alaska. There were two that said no. I think Pennsylvania was one of them. I don't know why. Anyway, New York passed it. So MITFA was passed, which is a variation of this. It basically said, if my value goes down, in the past I couldn't touch the money, even though the donor said I could. but it went below the original value, I had to make it up and I couldn't have any money. The Prudent Management Act said you can still use it and be prudent about it, because you know the market's going to go up. But the old rules, without the prudent, and the accounting rules were similar, you couldn't. So now the accounting rules got changed. There was an update. And the update said, basically, that it conformed to the UPMIDFA and the General Uniform Management Prudent Act, that you can now take money out that is, even if the funds go lower than the original value. And this is what they mean by underwater. It went down under the original value. Furthermore, more important, or equally important, it said you don't have to make up your funds from unrestricted to endowment. In other words, it could stay there. So if the funds go from $1 million to $800,000, it stays in endowment. You don't have to transfer money, which was really a big change for small organizations. I know a number of organizations, they really are, they make $600,000, $700,000 out of a budget, but they have an endowment of $200,000 or even $500,000 that they can't touch. And when the market hit, it was very burdensome on them. So this change, I think, is fair. I won't go into much more on that. Just so you know that there's a rule, if you have endowments, you're at least aware it's out there on how to account for it. Okay, and just to finish it up, I'm not going to spend much more time because a lot of people here don't have that. But there's certain disclosures if you have an endowment that you now have to make. In the past, you pretty much had to make them anyway. New York State required it, but now it's in the accounting rules. Sometimes the accounting rules catch up with the other rules in reality. And I gave a sample note in here if you do have that, what you have to disclose. Okay, let's move on to some of the other changes. Another change was, I already told you, if cash is restricted, it has to be separated. You can't combine it with unrestricted cash and long-term cash. So that has to be broken out. Here's a rule that I actually think is one of the good rules. How you report your investment income. The old accounting rules said you must show your investment income and you must show related expenses. Now, investment income we don't understand. That would be realized gains, interest, dividends, and unrealized. If your investments change from year to year, you have to pick up unrealized. What does unrealized mean? The difference between the original cost of the investment and the fair value. You're supposed to pick that up in the past and identify it. That's income. What do you mean by investment expenses? Well, investment expenses could be the brokerage fee, what they charge for buying and selling, or management fee, especially an endowment, how much the broker charges to manage your portfolio. In some very big portfolios, the management fee is pretty high. The old rules, you had to break it out. Here is our investment income, interest, dividends, capital gains, unrealized gains and losses, total, less investment expenses, net. The new rules say you don't have to do that anymore. You now can do it net. If you want to disclose the pieces of it, you can, but you could say net investment income is $40,000. You don't have to say investment income broken down is 60 minus 20, or that's a high expense, but a less investment expense net. Here's the rationale behind that. And I think it's a good rationale. Investment expenses are buried most of the time. So you couldn't even report this. You could report what your gains are, you could report what your interest and dividends are, but what is your investment expenses? If the broker's charging for buy and sells, it's built into the price of the purchase and the sale. It's in that value. Try to get that information. I can't tell you how many times over 30 years I've tried to get that from a broker. Big brokerage houses, they bury that. I guess for obvious reasons. Anybody here a broker? No offense if you are. It's just that brokers agree with me anyway. I mean, it's not something you want to, especially if you're charging a little bit more than you should be. So getting the information was difficult, so how do you report it? So it was an exercise in futility. Counting body's gotten rid of it. That's a change. What other? One that doesn't really affect most of you. Donation of long-lived assets. If I didn't lose you in anything technical so far, I will at this point. Somebody donates a building. Even could be the city. You know, somebody donates a building. I have an organization in Queens. They get a city donated a building. I know other organization, arts organization in the city. Some organization gives them space. It's worth a lot of money. The old rules made you pick up the building as what they temporarily restricted for operations, and as you depreciated the building, it's expensed it over its life, you then released it. That was the old rules. The new rules say, we're not doing it on depreciation. You pick up a building as basically unrestricted or without donor restriction, to use the new term, and you just basically you depreciate, but it's all unrestricted or without donor restriction. That's all I'm going to say about that. Okay. Going concern, another technical area. Hopefully won't affect everybody in this room. I'll tell you the old rules and the new rules. This was really for the auditors, mainly. It wasn't really for other people. In the past, the auditor comes in, they do the audit, and they say, you guys are negative. You're borrowing on your restricted money. You're living off not paying your bills. You know, have a big accounts payable. You're borrowing money. How are you guys going to stay in business? And of course, the answer is, oh no, we expect a big grant. We have a big fundraiser. We're working on something, and you guys can fill in the rest of the story. So they would tell the auditor had their job in the past was to determine whether the organization could continue as a viable entity, as a going concern. And if the auditor felt, I don't see where this, you had losses not 1 year, 2 years, and it's very high, I don't think you can do that. Then the auditor was supposed to either determine what would cost to go out of business, or disclose it in the notes, or put it in their opinion. That was the old rules. The onus was on the auditor. And it was very burdensome on the auditor in one way, because there was a conflict there. Nobody wants this disclosure. If you weren't going out of business, definitely, when you put this disclosure in, and why it's so important, it's going to accelerate you going out of business, because who wants to give money to an organization that's sinking? Including myself. Do I want to donate money to an organization that might not be surviving? So it could accelerate that problem. So it's a very, very delicate and serious type of disclosure. And the onus was on the auditors. So what they decided to do is put it where it belongs and say now the new rules, they changed the accounting rules under the FASB, and they also changed the auditing rules under something called generally accepted auditing standards. Both rules were changed, saying in the auditing side, the auditor does not do this anymore. They don't determine this. But they do determine something, not this. The accounting side said the organization must determine, I love this, the organization must determine if they have a going concern. Yeah. I could see everybody rushing and putting that paragraph in. So basically, what's new is old. The only difference is it's a technical difference, because now the auditor's job is determine whether the organization is disclosing things properly, just like every other disclosure in the financial statements. If the organization is disclosing they're expecting a receivable, the auditor has to determine if that receivable is real. If the organization is or isn't disclosing they have a going concern, the auditor has to determine whether that disclosure is appropriate, and if they disagree with it, might have a qualified opinion. So, it kind of sounds like it might be different, and it is different, but in a way it isn't. It just takes the legality and the basically the procedure and switch it around a little bit, and making the organization responsible. But it still requires the same kind of treatment. It's just who's responsible for this. That's on the going concern. This one, called Revenue with Contracts with Customers, which is the ASU 21409. Fortunately for most not-for-profits, it's not as important. The reason is not-for-profits get most of their money from grants and contributions. However, a lot of organizations do have contracts to perform services and to even to produce products. I was a chairman of an organization before they went out of business in Brooklyn called the New York City Industries for the Blind. And they hired blind or sight impaired people and to actually make products. It's hard to imagine, but basically it was a factory making brooms and uniforms. And they sold it to the Army and to other services in the government. That was a product. So you have agreements to sell. Or if the organization does consulting work, you're doing it. This rule now pertains to every organization. When do you book revenue? When do you say you have a contract? So for those organizations that have this, not-for-profits, it will pertain to them, just like every other organization. What does it mean? It means that they took what should have been in existence and was in existence and put it down in writing, making it very clear how you should record things. In other words, it didn't change what you were doing. It just made it less feasible to play around. In other words, an example. You have a contract to do something. Is it in writing? Is it signed? Does it specify what the terms are? Under the new rules, and they identify it's actually 5 specific areas. I wish it was as easy as just saying 5 because within each area there's a lot of verbiage and a lot of text. If these things apply, this is when you then pick up the revenue. So if somebody says, I am going to hire your organization to provide training to my constituents, and they say that in an email, some organizations in the past would show their auditor and say, yeah, we're booking this. We have an agreement to sell it. We have a receivable, and we have revenue, program service revenue. Under the new rules, you can't do that. It's making it almost scientific to when you pick up revenue. And it says you have to have a contract. You have to identify. And when I say contract, basically some form of writing. It can't be an email saying, yeah, we'll buy this. So you have a contract. What are your obligations in this contract? When is money paid and when is performance done? When is there an exchange? You have to identify. If it's something over, let's say somebody is building a website, the organization is helping organizations. I have a client that helps a lot of other organizations develop internet skills, and they go out and they do consulting. When is the actual service being performed? You have to know that because you don't earn the money until the service is performed. If I say to you, we have an agreement for me to hire you for 3 years to do something at $300,000, $100,000 a year, do you have to do things for that? Well, yes, the first year I have to do something, the next year I'll do the same thing, the year after the same thing. You don't pick up $300,000. Now there's a lot of pressure to pick up the whole thing and say I'm doing well. Now this was the old accounting rules too. You should pick up based on when you've really earned. This is the accrual basis of accounting for those that like an accounting term. It didn't change it, it just solidified when you book it. Not-for-profits don't have this as much, but it will affect you. There is some exclusions from it. Leases, insurance contracts, financial instruments, guarantees, and non-monetary exchanges. What's a non-monetary exchange? Donation. So it pulls that out of the rules. Leases. This one is, to me, I think it's kind of, I don't want to use the word funny, because it really doesn't change the net number, but a lot of people are going to be bothered by this, because it's going to change the composition of your statement of financial position, your balance sheet. Basically, it affects operating leases. Now, what is an operating lease? And I'll answer that in relation to a capital lease. Capital lease means I'm basically owning something. I'm getting a lease, but at the end of the lease, I'm basically buying it. Best example is I'm leasing a copy machine. I'm paying whatever I'm paying each month. At the end of the lease, I can buy it for $1. That's really not an operating lease. It means I really bought it. It's just a financing agreement, as opposed to really leasing the copying machine, paying monthly lease, and at the end, you turn it back in. Now, leasing of equipment's not a big one on there, unless it's a very big organization that has a lot of equipment. Where this really pertains to most organizations, it's office leases. People have leases that go out a number of years, and even small organizations could have, even if it's $1,000 or $2,000 a month, it adds up. The new rules affect operating leases and affect how you record and really record this on your financial statements and present it both as the leaser and the leasee, but we don't have leasing companies in here. So just us as the leasee, the people that are getting the lease. In the past, for those of you that remember your financial statements, you would see at the notes something called, and I have an example on the other page, what your commitments are. The little note in the back that says, we have the following commitments. So the reader knows you're locked into paying whatever over a number of years for equipment. You must first describe it. What are your leases or commitments? And there's a little description in there. And then, in the past, the old rules, you would list, you know, that our minimum payments are the following, next year, next year, next year. And if this is a fairly average-sized organization, a couple million, I might have a commitment of $1 million, and you put it in your notes. It didn't affect your financial statements at all. New rules. I sound like Bill Maher. Anybody used to watch Bill Maher? At the end, he had new rules. Kind of like that. New rules. Except I don't have these animation. New rules. Well, capital leases are the same. So I should have put in front of same capital leases. Capital leases are the same. No change there. It's operating leases. Basically, if you meet the test, you must record your benefit, your use, what you got in your lease, and your liability. What I mean by that, you're picking up a number that's going to be on your asset and your liability. It nets to zero, but it inflates your asset and inflates your liability. I'm going to explain to you that. First, you have to meet certain terms. It has to be non-cancelable. Very important. Can't be you can back out at any point. You need to come up with a discount rate, which you use for a lot of things, like long-term contributions. Come up with some rate, whatever that you think is appropriate that you use for your loans or something. And then you must figure out, what am I actually paying over the whole course of this lease? Whether there's terms that change, escalations, or money up front, or whether the leaseor is giving you something free. You must determine all these elements first before you can do any numbers. Then you record what they call a right of use. You're going to see my little acronym, ROU, a right of use. I have the right to use this property to run my organization. And the liability is what I owe the leaseor for leasing this property. Now this rule doesn't take place until I think 2019 I had it down on the leases. Yes, it's really years beginning 2020. It's funny, the accounting financial statements are effective this year. The leases, which I don't think is as onerous, we have many years to do. So you don't have to worry about it right now. So what do? You have to record what the present value is of all these lease payments, over whatever years of the lease, the number of years. You have to figure out the discount rate. What are you going to amortize each year? You could have your accountants help you, I guarantee you. And then you have to figure out, how much am I physically paying? Let's say I get the first year, they give me 6 months free. So you have to figure what your cash flow. You need all those pieces. Then it becomes a accounting kind of issue here. Here's some examples. Well, one example with some pieces. So we have a 3-year lease beginning in 17. First year I have $12,000. I made it easy, $1,000 a month. It has an escalation clause. It goes up next year 13.2, and the third year 15. We're using a discount rate of 6. Might be a little high today, but it's not crazy. So here's what you calculate. So what am I physically paying? Well, when I add everything up, it's going to come up to $40,200. That's assuming the math is right. I believe it is. If you bring it back, when you discount 6%, it's today's value $36,725. And what am I actually paying? Well, the accounting rules follow the old accounting rules. Because you could play around with your lease and the terms of the lease, the landlord will do something free.